Welcome to Nothing Venture, a weekly series of 2-minute videos covering big news and educational content in the venture markets. I'm your host, Luke Antal, co-founder and chief community officer here at Alumni Ventures. Last week, we covered the difference between a venture lead investor and a co-investor. And in today's episode, we're walking you through the different stages of venture investing. There are lots of nuances to this, but to keep things simple, venture investing can generally be bucketed into 3 separate stage categories: seed, early, and growth stage investing. Seed and pre-seed rounds represent the earliest possible opportunities for investors to put capital to work. At this point in a company's life cycle, it's usually just the founders and maybe a very small team of a few people. These companies are usually pre-revenue. They have identified a problem and have a vision on how to solve it. Investment at this stage typically goes towards building a working product and finding an initial customer set. Seed and pre-seed stage venture investing represents the largest opportunity for returns, but also has the highest company mortality rates. Great seed stage venture investors have a knack for investing in founders who have a strong track record, a big idea addressing a large addressable market, and know how to be scrappy and productive at the same time. Seed financing rounds can range from a few $100,000 all the way up to $5 or $10 million in some cases. Next up is early stage venture investing, and this typically refers to Series A rounds. At this point, companies typically have early success and they've found product market fit. This means that they've got a working product and they've started to generate revenue from a relatively small set of customers. They need capital in order to scale their business to a much larger set of customers. Early stage rounds of financing can range from roughly $10 million to $30 million and are extremely competitive to get into from a venture standpoint. Because the company usually already has some traction, some of the risk has been mitigated and the upside can still be quite significant. Next up is growth stage investing, and this typically refers to Series B stage and later. Companies that reach this stage typically have 100+ employees, sometimes thousands. They have a working product, large customer base, and they are in full-on scaling mode. Round sizes can be very large here, usually in the many tens of millions, sometimes in excess of $100 million. These investments are typically considered less risky, but they also come with a lower ceiling from a potential returns profile. At Alumni Ventures, we believe the right way for individuals to invest in venture is to have a highly diversified venture portfolio. As such, almost all of our funds follow this strategy. Exceptions to the rule are our seed fund, which focuses, as you might expect, on seed and pre-seed stage investing, and also our growth fund, which exclusively invests into our existing portfolio of 1,000+ companies that are proving to have very strong traction. Well, that's all for now. Thanks for tuning in. Be sure to follow Alumni Ventures on LinkedIn, and please join us next week. Take care.